The mainstream financial world loves the Austrian narrative. A flawless bastion of Alpine stability, a perfect social market economy with a robust middle class, the ultimate bridge between East and West. Every single piece of that narrative expired a decade ago. What you are actually looking at is a museum economy. It is a perfectly preserved facade constructed by legacy political parties and bureaucratic institutions. It is specifically engineered to look like permanent prosperity, while the structural engine underneath has completely stalled, and specific mechanisms are keeping this illusion of wealth intact. A total reliance on a dying German industrial sector, a tax burden that crushes ambition before it starts, a coordinated brain drain of the brightest young minds, and an institutional refusal to admit that the golden era is over. The cracks in this Alpine fortress are not forming. They are already critical. By the end of this video, you will understand exactly how a wealthy nation quietly dismantled its own future. There was a window, a 30-year window, and Austria exploited it better than almost any country in modern European history. When the Iron Curtain fell in 1989, Austria woke up to find itself in the most strategically valuable real estate on the continent. It sat directly between the wealthy, industrialized West and a newly opened Eastern Europe hungry for capital, expertise, and access. Vienna was not just a city, it was a gateway. Multinational corporations planted their regional headquarters there to manage the eastward expansion. Austrian banks poured capital into Hungary, the Czech Republic, Slovakia, and Romania. The country became the indispensable connector, the trusted intermediary between two economic worlds that had just been reunited for the first time in 50 years. The profits were real, the growth was real, the confidence it built was also real, and that is where the danger started. Because Austria did not use that window to build something new. It used the windfall to entrench what already existed. The banks got bigger, but not more innovative. The political establishment got more comfortable. The social partnership, that famous arrangement between employers, unions, and the state to manage wages and policy in closed rooms, got more powerful and more resistant to disruption. By the time the Eastern European economies matured, built their own institutions, joined the EU, and stopped needing Austria as an intermediary, the gateway function quietly disappeared. The toll booth closed, and Austria, having never replaced it with anything else, was left standing on a bridge to nowhere, still charging admission for a crossing nobody needed anymore. The window is shut. The question is what Austria built while it was open, and the answer to that question is what makes the next 30 years look completely different from the last 30. If the collapse of the Eastern Bridge was a slow puncture, the second blow arrived faster and hit harder, and it came from the one partner Austria had always treated as a permanent guarantee. Germany accounts for roughly a third of Austrian exports. That figure has held for decades, and for decades it was a source of stability. Austrian manufacturers fed into German industrial supply chains. Austrian companies grew on the back of German demand. The relationship was so close, so structural, that when German economists described their supply chain ecosystem, Austria was embedded inside it almost invisibly. Then Germany stopped being the engine of European growth. The German industrial model, built on cheap Russian energy, Chinese export demand, and internal combustion manufacturing, ran directly into an energy shock, a geopolitical fracture, and an electric vehicle transition it was not structurally prepared for. German manufacturing contracted sharply. German growth flatlined. And because Austrian manufacturing sat inside that ecosystem, it contracted too. In 2024, Austrian manufacturing declined by 5.6% in the final quarter alone. The broader economy contracted by 1.1% over the full year, making it the longest sustained economic downturn Austria had recorded since modern calculations began in 1995. Corporate insolvencies surged by 22% in a single year. These are not rounding errors. These are the numbers of a structural exposure becoming visible for the first time in a generation. Austria did not build a German-sized problem, but it built something arguably worse. A German-shaped dependency with no plan to reduce it. When your most important customer stops buying, you find out very quickly how much of your prosperity was yours, and how much was borrowed from someone else's engine running at full speed next door. If you want to understand why this matters for your own financial future, subscribe now so you do not miss the next part of this breakdown. We are just getting started. The bureaucracy was supposed to be the feature, not the bug. Austria's legendary social partnership, the Social Partnerschaft, is one of the most studied institutional arrangements in the developed world. 4 major bodies representing employers, employees, agriculture, and trade sit in permanent negotiation to co-manage wages, working conditions, and economic policy. It emerged from the ruins of the Second World War as a deliberate mechanism to prevent the kind of class conflict that had helped destroy the First Republic. For 30 years, it worked. Austria had industrial peace, rising wages, and stable growth at the same time. The world looked at it and took notes. The problem is that the same architecture designed to prevent destruction in a manufacturing economy actively prevents creation in a digital one. Starting a company in Austria requires navigating a labyrinth of registration requirements, mandatory chamber memberships, and sector-specific licensing structures that have no equivalent in Silicon Valley, no equivalent in Singapore, and no equivalent in the startup ecosystems that are pulling the next generation of wealth creators away from legacy European systems. The OECD has noted consistently that product market regulations in Austria are among the strictest in the developed world, with particularly high barriers in professional services. Venture capital penetration remains one of the lowest in the EU. Business funding is overwhelmingly concentrated in bank loans rather than equity, meaning that the kind of high-risk, high-reward entrepreneurship that produces new industries simply does not get financed in the structure that exists. The social partnership was built to protect what already existed. It was never designed to build what does not yet exist, and in an economy that needs reinvention, that is not a minor design flaw. It is the entire problem. Let us talk about where your money actually goes. Austria has the 5th highest tax wedge among all 38 OECD member countries. That tax wedge, which measures the total tax burden on labour including income tax and social security contributions, sat at 47% in 2024. The average single worker in Austria takes home 67.7 cents of every euro they earn. The OECD average is 75 cents. That gap is not a rounding error. It is 8 cents on every euro every month for every year of your working life, disappearing into a system that is running a deficit of 4.7% of GDP. The top marginal rate reaches 55%. Now, what is that money funding? Pension expenditure is already strained and projected by the OECD to require an additional 5.8 percentage points of GDP by 2060. A healthcare system that is heavily hospital-centred, inefficient by the OECD's own analysis, and consuming a share of output that has no corresponding improvement in outcomes. A welfare architecture designed in the 1970s for a demographic structure and an economic model that no longer exist. Here is the mechanism that makes this truly unsustainable. The tax base is funded primarily by the middle class, because Austria has almost no capital gains tax on inherited property, and legacy wealth is structurally protected. The cost of the system rises. The number of productive workers paying into it grows more slowly than the number drawing from it. The deficit widens, so the state raises indirect taxes, as it did in early 2025 when energy relief measures expired and prices surged immediately. The middle class absorbs the hit, again, while the architecture itself remains untouched. The museum does not charge admission fees. It runs on the monthly salary of everyone who cannot afford to leave. So who leaves? This is the chapter nobody in Vienna's policy class wants to discuss at full volume, because the data is uncomfortable and the conclusion is worse. Austria is losing its most productive people. Not dramatically, not all at once, not in a way that generates headlines. Quietly, systematically, and at exactly the wrong moment in the economic cycle. Young engineers graduating from TU Wien and accepting positions in Zurich. Doctors completing their training in Vienna and registering with practices in Germany or moving to the United Kingdom. Entrepreneurs running cost-benefit analyses on Austrian bureaucracy versus Swiss incorporation and making a very obvious decision. Researchers finishing their PhDs and accepting a postdoc in Boston because the funding gap between Austrian and American research institutions is simply not closable. The OECD and European Commission analyses consistently identify Austria in the same cluster of countries where graduate emigration patterns show an employment rate gap. Austrian university graduates working in other EU countries find not just higher nominal salaries, but meaningfully better net income after the tax wedge is applied. Switzerland, which shares a language, a culture, and a short train journey with Vienna, offers a top marginal tax rate roughly 20 points lower. The mathematics is not complicated. What makes this particularly difficult to reverse is its self-reinforcing quality. When the people most capable of building new industries leave, the industries are not built. When the industries are not built, there are no high-growth companies to return to. When there are no high-growth companies, the next generation of talented graduates runs the same calculation and reaches the same answer. The brain drain is not a crisis event. It is a slow erosion, and slow erosions are the hardest kind to arrest because they never feel urgent enough to stop. When labour income stops being the vehicle for wealth creation, people turn to property. And in Austria, that transition happened a long time ago. Austrian real estate has been the default store of generational value for decades. Vienna's property market was largely stable, culturally anchored, and socially embedded in a way that made inherited real estate the primary mechanism through which wealth passed between generations. A majority of Austrian households with meaningful net worth are holding that net worth not in productive equity, not in investment portfolios, not in business ownership, but in the walls and floors of apartments and houses that are either lived in or rented within a heavily regulated market. This is not inherently a catastrophe when an economy is growing, when property values are rising, and when the productive economy is generating enough activity to support the service sector around those properties. But Austria's economy contracted for 2 consecutive years. Construction declined sharply. Investment in new capital goods dropped to its lowest levels in years. The property market, which had already gone through a correction after the rate rises of 2022, is not a rising tide. The deeper structural problem is that wealth locked in property is not wealth being deployed. It is not funding new companies. It is not going into venture capital. It is not creating jobs. It is sitting, appreciating slowly, and being passed down under a tax structure that explicitly shields it from the burden that falls on earned income. The middle class pays 47% on their labour. Inherited wealth pays almost nothing. That is not a welfare state. That is a class system with a welfare state built on top of it to make the arrangement tolerable. The people who could change any of this know exactly what is happening. That is not the problem. The problem is that they have no structural incentive to change it, and every structural incentive to protect what already exists. Vienna's political and corporate establishment operates through a system of interlocking relationships between the major parties, the chambers of commerce, the social partnership bodies, the state-owned enterprises, and the banking sector that has remained largely intact since the post-war reconstruction. Positions circulate. Former politicians become lobbyists. Former lobbyists become regulators. The same families, the same institutions, and the same networks hold the same positions with different titles across successive decades. This is not unique to Austria. But Austria's version of it is particularly resistant to external pressure because the country is simply not big enough and not dependent enough on foreign capital to be forced into reform from the outside. Ireland was forced to reform after 2008 because it needed a bailout, and the Troika had conditions. Greece was restructured against its will. Austria, sitting on respectable foreign currency reserves, a still functional credit rating, and a population too small to generate the kind of social pressure that rewrites political settlements, simply does not face that forcing function. The OECD has recommended the same structural reforms in consecutive annual surveys: ease professional services regulation, introduce more growth-friendly taxation, reduce barriers to venture capital, and simplify administrative procedures. The recommendations sit in the reports. The reports sit on shelves. The elites who commissioned the reports continue managing the system they were trained to manage, protecting the assets they have accumulated inside it, and waiting for a recovery that does not require them to change anything fundamental. That is institutional arrogance. And historically, it has one inevitable endpoint. The endpoint arrives when the numbers stop being deferrable. Austria's government deficit reached 4.7% of GDP in 2024, well above the 3% ceiling required by EU fiscal rules. Public debt crossed 80% of GDP and is projected to continue rising through 2027. The government's own fiscal consolidation package, announced in early 2025 and worth €4 billion, includes the abolition of the climate bonus, higher indirect taxes, and cuts to public investment. These are the choices a government makes when it has run out of easy options and is now choosing between bad and worse. The trajectory is mechanically readable. Pension and healthcare expenditure will rise as the population ages. The working age population is already beginning to shrink. reducing the tax base that funds everything else. The most mobile, highest-earning members of that workforce are the most likely to leave. Corporate insolvencies will continue rising in 2025, reducing business tax receipts at exactly the moment the state needs them most. Energy prices, which jumped sharply in January 2025 when government support schemes expired, will keep services inflation above the European average, squeezing consumer spending and suppressing the domestic demand recovery that the growth forecasts depend on. None of these pressures is secret. Every European institution monitoring Austria has published versions of this analysis. The question is not whether the breaking point is coming. The question is whether it arrives as a managed restructuring or as a sudden loss of confidence in the system's ability to sustain itself. History suggests that countries with Austria's institutional stubbornness tend to wait for the second option. And the second option is considerably more painful than the first. So here is where you actually are, and here is what you can actually do. You live inside a system that was designed for a different century, by people solving different problems, for an economic reality that no longer exists. That system will continue to function in a reduced and increasingly expensive form for some years yet, but it will not generate the upward mobility it once promised. It will not reward the kind of ambition it was built to accommodate, and it will not protect the wealth of the middle class who fund it, because the architecture was never designed with your interests as the primary variable. The people who built generational wealth inside the Austrian system did so by either inheriting property before the game changed, or by operating at the institutional level, where the rules do not apply in the same way they apply to you. The social partnership is not a mechanism for your advancement. It is a mechanism for managing your expectations. What that means practically is this: the most important financial decision you can make right now is to stop building your entire future inside a system that is structurally designed to extract from you rather than elevate you. That does not mean leaving Austria. It means building income streams, investment positions, and financial assets that exist outside the reach of a 47% tax wedge. It means understanding that the identity this economy offered, the stable job, the pension, the safe trajectory, was a product of a specific historical moment. That moment is over. The blank slate is not a disaster. It is an instruction. Build something new, independently, before the museum charges you the full cost of maintaining it. If this breakdown gave you a sharper picture of what is actually happening around you, share it with someone who needs to hear it. And if you want the next country breakdown delivered straight to you, subscribe. There is a lot more to cover.